Financial Accounting FRK311 Assessment 1 questions 14 and 15 feedback. Now there you have question 14 in front of you. In this case, it was a barter transaction. We exchanged a custom-made packaging equipment for another machine, and all that you had to do is firstly realize that at what amount are we going to transfer this asset. Now usually the rule says the new asset will be brought into your books at the fair value of the asset given up plus or minus any cash received or paid. Right, but in this case you did not have the fair value of the asset given up. You do have the fair value of the other asset, and that's your second go-to. If you don't have the fair value of the asset given up, then you look at the fair value of the asset that you received. And in this case, the fair value of that asset that you received was 522,000. So that will be the starting point for the new asset in your books. But you also received an amount, of 72,000. But that 72,000 was set off against the profit that you actually made on the original asset. So the new asset will be brought into your books at 522,000. And that is your starting point for your calculations. So when you now go to your calculations, and you will see that firstly, there at number B, if we look at 522,000 divided by the 6 years times 8/12, being the 8 months that is in use in current year, that's the first part of the depreciation. But many students forgot that the original asset also had a useful life of still 4 months. So your calculation there, 625,200 divided by the 5 years times the 4/12, that will give us the depreciation for the original or the old asset. So the two together made up the 99,680,000. So the only catch that this question had was the 522,000 being the fair value of the machine that you acquired. The 72,000 that you also received was for the old machine, because the old machine was worth much more than the new machine that you received. Okay, then question number 15. In question number 15, straightforward, you just had to work backwards. You were given first, you were required to calculate the original cost of this machine, but you were also given that the machinery is accounted for according to the cost model and depreciation is over the straight line basis. I didn't give you the useful life, but SARS grants a wear and tear allowance of 20% per annum on the straight line basis on the cost of the machinery. So that was your starting point. Now that is not the wear and tear was not proportionally allocated to a portion of the financial year. So that means every year that there were wear and tear, that would have been 20% straight. So your calculation, your deferred tax calculation for the previous year was given to you, and your deferred tax amount was the 8,960. And then we told you that the journal that had to be put through for the current year was credit the deferred tax balance with 4480. So if you add that 4480 to the 8960, you will then get an amount of, let's see, there you added it and you'll get an amount of 13,440. Now that is the deferred tax balance on this asset. Now it's stated at 28%. So for that reason, you had to go and calculate the before tax temporary difference, which is 48,000. Now once you've calculated that, let's go back to the previous slide. then you can see this answer here, that little answer there, you have now calculated as, 48,000. So now all you need to do is calculate that difference there, which is this amount here. 160 minus 48 gives you 112,000. Now that you've calculated 112,000, you can go and slot it in there. And the difference between these two amounts will now be the depreciation for the wear and tear rather for the year. So let's go and look at there. That is your wear and tear for the year, which is 56,000. So if that is the wear and tear for 1 year, what will be the total for 5 years? And therefore you go and calculate that the original cost of this asset was 280,000. So your answer is then number D, 280,000. Thank you.